Every few decades, something shifts in global markets that fundamentally changes the rules of wealth building. In the 1970s, it was oil. OPEC's embargo created a decade of commodity dominance that built generational wealth for investors who were positioned correctly. In the 1990s, it was technology. The internet changed everything and tech stocks went vertical. In the early 2000s, it was real estate. Easy credit and global demand sent property values to historic highs. And right now, in 2025 and 2026, some of the most respected analysts in global finance are calling the beginning of something that happens once, maybe twice, in a generation. They're calling it a commodities supercycle. And if they're right, the financial opportunity in front of you is one of the biggest of the next decade. Let's define the term precisely, because it gets thrown around loosely. A commodities supercycle is an extended period, typically lasting 10 to 20 years, during which raw material prices broadly rise above their long-term trend. It is not a seasonal spike. It's not a short-term trade. It's a structural shift in the global supply-demand balance of physical materials that sustains elevated prices across an entire asset class for a generation. History is clear on this. The post-World War II industrial boom from the 1940s through the 1960s created a sustained supercycle as rebuilt nations consumed enormous quantities of raw materials. The commodity boom of the 2000s, driven by China's mass industrialization, created another, lifting copper, steel, oil, and agricultural goods for over a decade. Supercycles don't turn on a monthly chart, they develop over years, which means that if we are indeed at the beginning of one, the investors who recognize it early and position accordingly have a very long time horizon to benefit. So, what are they actually looking at that makes them so confident this is a supercycle, and not just a good year for commodities? The returns since the end of 2024 are, frankly, extraordinary. Gold is up 65%. Palladium is up 95%. Platinum is up 150%. Silver is up 170%. When you see this kind of coordinated, broad-based movement across the entire metals complex, not just one metal, not just one country, not just one use case, that is historically the signature of a supercycle beginning, not a short-term speculative trade. Each of these metals is driven by completely different underlying demand factors. Gold by monetary fear and central bank buying. Silver by simultaneous industrial and monetary demand. Platinum by hydrogen and clean energy applications. Palladium by supply concentration and auto catalyst demand. They shouldn't all be rallying this hard at the same time, unless something structural is changing in the global economy. And something structural is changing. Every supercycle has a unique driver. The post-war cycle was about rebuilding physical infrastructure. The 2000 cycle was about China urbanizing 600 million people in 2 decades. This one has 3 distinct drivers operating simultaneously, and that's what makes it potentially more powerful than its predecessors. Driver 1, AI and electrification. The build-out of AI data centers, electric vehicle infrastructure, and renewable energy systems requires massive quantities of copper, silver, lithium, and rare earth metals. This demand is not cyclical. It is structural. It will not slow down for a decade. Driver 2, de-dollarization. As governments move away from dollar-denominated reserves, they are moving toward gold and other hard assets. This is a multi-decade geopolitical realignment. It doesn't end when interest rates change or an election happens. Driver 3, supply constraints. Mining is capital-intensive and slow-moving. No major copper mine gets built in under a decade. No new silver supply comes online quickly in response to a price signal. The supply side of this equation physically cannot respond fast enough to meet the demand surge, and that gap is what sustains elevated prices. If we are at the beginning of a supercycle, the most important question for any investor is, which metals have already run, and which still have the most upside ahead? Gold has led this move and is the most established. It is the safest entry point, but likely has the least remaining percentage upside given how far it has already traveled. Silver remains undervalued relative to gold by historical standards. The gold-to-silver ratio suggests silver should be significantly higher in relative terms. Its industrial demand tailwinds are ones gold simply doesn't have. Silver likely has more percentage upside from here than gold does. Platinum is coming off a multi-decade period of underperformance and has just broken to record highs for the first time since 2007. The hydrogen economy is a long-term structural demand driver. Platinum may have the most dramatic catch-up potential of the major metals. Copper is the metal most directly tied to AI and global electrification. If those trends continue for 10 years, and there's no serious economic argument they won't, copper demand will significantly exceed supply for most of that period. You don't need to be a commodities trader to benefit from a supercycle. Here's a practical framework for different types of investors. For broad exposure, a diversified commodities ETF or a multi-metal fund gives you participation across the entire complex without single metal concentration risk. One position, diversified exposure. For targeted exposure, allocate separately across gold, silver, and copper-focused instruments based on your own conviction about each driver. This requires more active management, but gives you full control. For leveraged exposure, mining stocks and mining ETFs amplify returns when underlying metals rise and amplify losses when they fall. Know your risk tolerance before going this route. And for the long-term investor who simply doesn't want to actively manage, a 10 to 15% allocation, a combination of gold and silver ETFs held for a 5 to 10-year time horizon, is a straightforward way to participate in a supercycle without requiring daily attention. The most important thing is not to wait for the certainty that will never exist. By the time a supercycle is confirmed by mainstream consensus, the easy money is already made. Supercycles don't announce themselves. They're recognized in hindsight by the people who missed them, and in real time by the people who were paying attention. The metals data from the past 18 months is as clear a signal as most investors are ever going to get. The question is not whether you understand it. The question is what you do with it. If this changed how you're thinking about the next decade of investing, subscribe. Because over the next several weeks, we're going deep on each of these metals individually, showing you the data, showing you the entry points, and showing you exactly how to build a position that can survive and thrive through a supercycle. See you next week.